When you're analyzing a company's financial performance, two key metrics that often come up are gross margin and net margin. But what do these terms even mean? Do they measure the same thing? In this video, we'll explore the difference between gross margin and net margin and how to use them effectively in your business. Gross margin is essentially the profit made on each sale before accounting for operating expenses. To calculate it, you take your revenue and subtract the cost of goods sold COGS from it. For example, let's say a company sells 100 units of a product at $10 each with COGS of $6 per unit. The gross margin would be $10, 6 x 100 equals 40% of sales. Now, while gross margin is an important indicator of profitability, it doesn't give you the full picture. That's where net margin comes in, which takes into account not just COGS but also operating expenses like salaries, rent, and marketing costs. To calculate net margin, you subtract both COGS and operating expenses from your revenue. Here's a simple example to illustrate this. Let's say our company has $100,000 in sales, with $60,000 going towards COGS and $20,000 as operating expenses. The gross margin would be 40%, $10,000 profit on $25,000 of sales, but the net margin would be at a more modest 10%, $10,000 profit after accounting for both COGS and operating expenses. Next up, let's talk about why understanding this distinction is crucial in business. When you're managing your finances, it's essential to know whether your revenue growth is translating into actual profits or just covering costs. If your gross margin is high, but net margin is low, you might be overpaying for COGS or operating expenses. For instance, imagine a company that has achieved impressive revenue growth through aggressive pricing strategies. However, if its COGS and operating expenses are also increasing at the same rate, its net margin may not be as impressive as its gross margin suggests. This can lead to cash flow problems down the line. Finally, let's discuss how to apply this knowledge in your business. When evaluating investment opportunities or partnerships, consider both gross and net margins. A high gross margin might look attractive at first glance, but if it's accompanied by high operating expenses, it may not be as profitable in reality. On the other hand, a company with low gross margin but efficient operations could still be an attractive partner. Quick recap. Gross margin measures profit before accounting for operating expenses, while net margin takes into account both COGS and operating expenses. Understanding this difference is crucial when evaluating financial performance or making investment decisions. It's essential to consider both metrics to get a comprehensive view of your company's profitability. In conclusion, by separating gross from net margin, you can make more informed business decisions that prioritize actual profit over just revenue growth. As we've seen in this video, it's not enough to focus solely on one metric. Instead, use them together to paint a complete picture of your company's financial health. Let's dive deeper into the implications of this distinction. When evaluating business opportunities or investments, it's common for entrepreneurs and investors to look at gross margin as a key indicator of profitability. A high gross margin can be attractive because it suggests that a company is selling its products or services at a price that exceeds their production costs. However, if you only consider gross margin without looking at net margin, you might miss out on some important red flags. For instance, suppose you're considering an investment in a company with a high gross margin of 30%. At first glance, this might seem impressive, but what about its operating expenses? If these expenses are also increasing rapidly, it could be eating into the company's net margin. To illustrate this point, let's consider an example. Imagine a food truck business that charges $10 per sandwich. Its COGS is around $5 per sandwich, leaving a gross margin of 50%. However, if the food truck has to pay high rent for its location, utilities, and labor costs, its operating expenses might be around $3 per sandwich. In this case, the net margin would be just 4%, which is much lower than the initial impression created by the gross margin. This example highlights the importance of considering both gross and net margins when evaluating business opportunities. A high gross margin can be misleading if it's accompanied by high operating expenses that erode the company's net margin. On the other hand, a low gross margin might not be as bad if the company has efficient operations that keep its operating expenses under control. To apply this knowledge in your business, consider conducting regular financial analysis to track both gross and net margins. This will help you identify areas where you can improve efficiency or negotiate better deals with suppliers. For instance, if you notice that your COGS is increasing rapidly, you might need to renegotiate contracts with your suppliers or explore alternative sourcing options. Similarly, when evaluating investment opportunities or partnerships, consider both gross and net margins. A high gross margin might look attractive at first glance, but if it's accompanied by high operating expenses, it may not be as profitable in reality. On the other hand, a company with low gross margin but efficient operations could still be an attractive partner. In practice, this means looking beyond just revenue growth and focusing on actual profit margins. When considering investments or partnerships, ask questions like, what are the company's operating expenses? Are they increasing or decreasing? How does the company plan to manage its costs in the future? By taking a more nuanced view of profitability, you can make more informed business decisions that prioritize actual profit over just revenue growth. This is especially important for entrepreneurs and small business owners who often have limited resources and need to be strategic about where they invest their time and money. In addition to considering gross and net margins, it's also essential to understand the drivers of these metrics. For instance, if you notice that your company's net margin is improving over time but its gross margin is decreasing, you might need to investigate why this is happening. Is it due to increasing COGS for operating expenses? Are there any changes in market conditions or competition that are affecting your pricing power? By understanding the underlying drivers of your profitability metrics, you can make more informed decisions about how to improve them. This might involve investing in new technologies or processes to reduce costs, renegotiating contracts with suppliers, or exploring new revenue streams. In conclusion, separating gross from net margin is crucial for making informed business decisions that prioritize actual profit over just revenue growth. By understanding the difference between these two metrics and considering both when evaluating financial performance or making investment decisions, you can make more strategic choices about where to invest your time and money. When analyzing the company's profitability, it's also essential to consider its cash flow. Just because a business